Every time you hit sell in your brokerage account, a decision gets made. Which shares specifically are being sold? And in a lot of cases, the client didn't make that decision, the brokerage did, using a default method called FIFO, F-I-F-O. That means first in, first out. And this can be a real financial pain point. So before we're going to talk about FIFO, you really need to understand what a lot is. Not like a lot of stuff, but a lot. So every time you buy shares of a stock, you create what's called a tax lot. It's a specific purchase. It's tied to a date, a number of shares, and the price that you paid. So if you bought Apple 3 times over the last 2 years, you have 3 lots. Same stock, 3 different cost bases. So now you have 3 Apple lots. So let's say hypothetically, the current price on Apple is $210 per share, and you want to sell 10 shares. Well, that's simple enough, but here's where the decision happens. Under FIFO, your brokerage sells the oldest shares first. That would be the January lot, the ones you paid $150 for. Now you sell at $210, that's $60 per share gain, and on 10 shares, that's a $600 taxable event. And since these shares are over a year old, it's going to be treated as long-term capital gains. Now, long-term capital gains are better than short-term, so in this case, FIFO didn't really kill you, but watch what happens when you get to choose. Specific identification that lets you elect which lot you're going to sell at the time of the trade. So instead of the January lot, maybe you choose the November lot. These are the shares you paid $200 for. Now your gain is $10 per share. So on 10 shares, we're talking about a $100 taxable event. You did not sell more or less, and you didn't change your position. You just chose the right lot that worked with your financial portfolio. In this example, that's a $500 difference in taxable income from one trade. Actual outcomes are going to vary based on your holding period, your cost basis, account types. It's going to vary on your individual tax situation. So why doesn't everybody do this? Well, there's 2 reasons. Number one is that most investors, they just don't know that this is actually an option. Like their platform, it defaults to FIFO and nobody really explains it to them. The second, even if they knew, they have to actively make this call on every trade. And that's just a discipline that many investors, they don't maintain it consistently. Now take that concept, choosing the right lot to minimize your tax bill, and apply it systematically across 150 individual stock positions. Every time the portfolio rebalances without you doing anything. And that's what modern direct indexing infrastructure looks like. It's not a one-time election, it's an ongoing process running in the background. That level of tax management used to require a $250,000 minimum and a separate management contract. Now that barrier is gone, but that's a different video for a different time, which I will do because I think it's such an important thing to learn. Now, here's what I want you to take away from this. Your brokerage is not trying to hurt you. The FIFO is a default. It's not some kind of weird conspiracy, but defaults are built for scale. They're not really built for a specific situation, and knowing that specific identification exists and that you can elect it, that's kind of the first step. Understanding how to use it systematically is the next one. So now if this was useful, subscribe because there's more coming on how portfolio construction has changed for people who are not managing $10 million. I mean, it helps for people with $10 million, but what about the people who don't have 10 million? That's what we're going to be focusing on and why that matters for what you keep after taxes.